Hello and welcome. This is the Insurance Pro Blog Podcast. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about life insurance.
Still got the crown.
Mm-hmm. We're a big deal in the life insurance market and a big deal in Greece.
In Greece?
Yeah, I'll tell you more about that afterwards. I forgot to mention it beforehand. Not something we have to get into right now.
Now everyone's curious.
Well, I'll just make vague references to things and then move right along. Who came excited to listen to a podcast about indexed universal life insurance?
I didn't know we had content about grappa. But evidently we do. Spanakopita.
Opa.
We're first in the Spanakopita game. There you go.
We are the heroes. See what I did there? Of life insurance.
Hey, if you're from the South, it's pronounced gyro. Sir.
I don't think that's just a Southern thing, but anyway.
So, what are we talking about today?
We're talking about indexed universal life insurance. We're talking about the big fear everybody has about universal life insurance in general.
It's going to blow up.
The fees, man, they're going to take your lunch.
Yep. Especially when you're older and you're living on a fixed income.
Look, my coworker's neighbor's cousin's daughter bought one of those their universal whole life policies years ago and found out it's not going to work.
Oh. She got a bill.
Mm-hmm.
She hasn't paid a premium in 32 years and she got a bill. Well, I mean, I'm being a little facetious, but only slightly.
If you're new here, we're sarcastic. Welcome. No, we are here to address this persistent claim that universal life insurance is a ticking time bomb.
Yep. Which we've talked about before, by the way, but we got a new spin though.
Well, we wanted to seriously test this, and it is our effort to screw it up. And it turns out you got to work really hard at it to screw it up. So let's set the stage, because the general idea is universal life insurance has an ever increasing cost of insurance.
Right.
Which whole life insurance does too. But it's kind of shrouded in a couple of guarantees that
they don't have to
may or may not affect the dividend long term.
Yeah.
So because of this, there is this claim peddled that universal life insurance is doomed to failure because that increasing cost of insurance is going to rob you of all the money that accumulates inside your universal life insurance contract.
Right. It'll eventually start pulling from your cash. Well, it always pulls from your cash value. Let me first say that. But it will begin to cannibalize itself. In other words, the cash value will decrease rapidly because of the increasing cost of insurance. And eventually you'll be in trouble and it'll be, oh no, if I don't pay $5,000 by a month from now, then I'm going to lose this coverage.
Is there a Nigerian prince who demands that?
Yeah, that's absolutely. They write about it in the Wall Street Journal every 4 or 5 years.
Yeah.
They do.
I know. Now, the Insurance Pro Blog from almost its inception has sat around going, nah, that's not always true. But, who are we? Just guys that like facts way too much.
We're just yell into the wind.
Yep. So the insinuation, though, is that this is almost a foregone conclusion for every universal life insurance policy that's ever been put in force.
Yeah.
And there's a shred of truth behind this.
The infinite banking crowd built their entire messaging around that fact.
They did. There's a little shred of truth behind this. And there's people out there with examples of somebody who bought a universal life insurance policy who ran into some trouble at some point. And we have litigated the whole reason why that has existed on numerous podcast episodes in the past. We're going to be very, very brief about that today. Just to say that they're execution problems where people bought what they thought was severely discounted permanent life insurance.
Yep.
And it turns out that discount didn't really exist.
Right. Well, that was a tactic that was used in the early days of universal life insurance sales.
Yeah.
Back in the 80s and early 90s. The common trope that we've heard, neither one of us were around at those. Well, we were around, but we were.
Some of us were playing with Ninja Turtles back then.
That's right. I was riding my Huffy around town back then. I never had a Huffy. I had a Schwinn. So there. But yeah. So what? I don't want to go too far down the rabbit hole, but basically, what happened a lot was that agents would take these newfangled universal life policies out to people who had had a whole life policy for a long time and say, Mr. Jones, you're paying $4,000 a year for this whole life policy. I can get you one of these universal life policies, same death benefit. It'll only cost you $1,800 a year.
Mm-hmm.
And Mr. Jones goes, well, that sounds better than $4,000.
Yep. And
that's how it was done. Mm-hmm. Now, that was done on the backs of universal life insurance having interest rates. Let's just say they were above 8% at the time. Yep. Some of them were much higher than that, but I'm being conservative.
Sure.
Well, the mechanics of universal life insurance being what they are assumed that 8% going forward. And as we all know, with the luxury of hindsight, the 8% didn't materialize. That's probably the highest it ever was, actually.
Yep.
And it went down, and therefore, but Mr. Jones kept paying the $1,800 a year.
Mm-hmm.
And so what he didn't realize at the time was as interest rates fell, he was actually underpaying what it was going to take to keep the policy growing. In other words, to keep the cash value growing, to keep the death benefit moving. Even if it was a level death benefit, it doesn't really matter. But eventually, what's going to happen is the earnings on the cash value are going to be lower than the cost of insurance. And so you're going to start gradually ratcheting the cash value backwards because you're not paying enough premium.
The subtraction of expenses exceeds the growth of cash value from the interest earned.
Right. Exactly.
So deletions are larger than additions, at which point in time you start the trend of running out of money and the policy lapses.
Or you get a notice saying it's going to.
Yeah.
That's how it usually comes up.
Yeah.
And so this harkens back to something you wrote over 10 years ago, I think now, where, trying to make the point that universal life insurance is not the cheap alternative to whole life insurance. That's not how any of this works. That's how it was sold, but that doesn't make it right because that's not how it actually functions. So anyway, that brings us to
well, that brings me to something I want to lean on that you said in your example, which is, Mr. Jones, you're paying X amount for this death benefit. I can get you the same death benefit for Y amount, which is less. These were very intently death benefit first situations.
As everything was back then, for the most part.
Yep. And still is today for the majority of life insurance sales.
Sure.
And that's not to say that if you're death benefit focused, you should buy whole life insurance. No. But what I'm pointing out is these were people who were sold on the idea that they were overpaying for whole life insurance. They could pay way less with universal life insurance, but that only worked if there was an interest rate paid on the cash accumulated in the universal life policy that was extraordinarily high.
Right.
So when that interest rate assumption didn't hold true, it turns out those people should have been paying roughly the same amount for their death benefit in a universal life contract as they were a whole life insurance contract, and they would have been fine.
Yep.
But because they didn't do that, they ran into problems.
Mm-hmm.
That brings us to the kind of central focus of today's discussion, which is when people are looking at a universal life insurance policy purchase today, or more specifically, an indexed universal life insurance policy today, because that's the majority of universal life insurance sales now. So when they are doing that, and especially when they're doing it with the focus primarily on the cash value buildup of the indexed universal life insurance, there's still this little voice creeping out from the insurance industry's sort of whole life only wing saying, but the fees are going to eat your policy, because they are referencing this time when people were trying to buy universal life insurance as the cheap alternative to whole life insurance.
Right.
But they are conflating the set of circumstances that led to that problem and basically applying it to today to say, hey, if you do anything with universal life insurance, you're going to have this problem that people had years ago.
Right.
Which is disingenuous.
Yes.
Full stop.
Mm-hmm.
So when it comes to universal life insurance, we have a whole lot of discretion over how we set various parameters of the policy.
Yes.
The death benefit, the premium, like there is no specific premium on a universal life insurance policy like there is a whole life policy.
Right.
If you come to me and say, I want to buy $1 million of death benefit with whole life insurance, they're going to tell me what you got to pay.
Yep.
With universal life insurance, I can kind of tell you whatever I want to tell you within a certain reason.
Mm-hmm.
Now, best practices would be to look at the whole life premium and match it to that if we're just trying to buy death benefit. But with universal life insurance, we have a lot of freedom to do a lot of things. And in the hands of somebody who knows what they're doing, that can be a very powerful thing. But in the hands of somebody who just got their insurance license, that could be a problem.
Yeah.
Or in the hands of somebody who's had their insurance license for a long, long time, but refuses to actually understand how universal life insurance works. That's also a problem.
Yeah, well, I was going to add one more, which is in the hands of people who have no guidance at all, which is how most of these people who ran into trouble with the old universal life policies got into trouble because someone sold it to them. They weren't around anymore. They never really had any contact with anyone, et cetera, et cetera.
Mm-hmm. Mm-hmm. Yeah, when you're left on your own in the wild and you don't really know what you're doing, you were just told, hey, pay this amount and everything will be fine. You do that for 30 years and find out everything's not fine. That's frustrating.
Yeah, it is.
So, given the context of all of this, we set out to figure out, all right, how badly do we need to implement an indexed universal life insurance policy to create an actual problem?
Right.
So what we did as the baseline is we took a male age 35, assume preferred. We're going to assume a 5.75% index credit on the policy. And we said, all right, if we're going to put $30,000 a year into an indexed universal life insurance policy, what's the correct death benefit? So minimum death benefit to qualify as life insurance and not be a modified endowment contract. That death benefit amount happens to be $637,000 at inception. I should also specify this is going to be an increasing death benefit until the person stops paying the premium in their mid-60s for the people who really want the super duper fine details. So that's it. $640,000, let's round up, call it that, is the death benefit we should have when we are trying to maximize cash value buildup on a policy where we intend to put $30,000 per year into the policy for some length of time. All right, that's our baseline. So then we said, well, all right, what happens if we double, triple, and so forth this death benefit, trying to figure out where we need to screw up in order to cause failure, which is this exact scenario that we talked about. At some point in the future, the expenses of the policy are going to be so high that they start deleting money from the policy faster than the accumulation of interest on the policy, and it just eventually lapses.
Mm-hmm.
So we started by doubling it, and cash accumulation isn't as good, but policy's fine. It lives for the entirety of the, let's call it tested period, which is all the way up to age 121. That's the maturity date of the policy. That's basically universal for life insurance policies. So then we went back to the initial non-MEC death benefit and we tripled it. And again, cash performance, not quite as spectacular, not bad actually, but policy exists for all the years that it needs to live. So no failure there. So we went back and we quadrupled it. And again, cash value performance, not quite as spectacular, just to quantify it for people. So when we did it the right way, minimum non-MEC death benefit, we get out to age 65, we've got like $2.2 million of death benefit, cash value that has accumulated. When we quadrupled it and we get out to age 65, we get like $1.5 million of cash value.
Mm-hmm.
So rate of returns is not as good, but still policy, not nothing. And policy is fine. It exists for all the years that it needs to stay in force for. So then we now this is going to get more complicated on the numerical stuff. Quintupled, I guess, is what we'll call it.
5x
and 5x. And again, cash value performance. Now it's like 1.3 million when we get to age 65, but it doesn't fail. Stays in force. So now finally, six times the initial non-MEC death benefit. That's 3.
So we've gone from $637,000 of death benefit to starting to starting with 637 to 3.8 million now.
Yeah, $3.8 million of death benefit at inception. And now we finally get failure in the early 90s.
Takes a lot.
That's 6 times the non-mech death benefit. That you got to screw up by a lot. You got to do something really, really dumb to put this thing in force. And I'm not talking about the consumer. The consumer's not really going to know. It's the agent who's doing the dumb thing here. But you got to do something astronomically stupid.
Yep.
To wreck this thing.
Mm-hmm. And by that logic, you'd need you would need to get a similar outcome to the $30,000 premium with the minimum non-mech death benefit of $637,000. If you wanted a similar result in our internal rate of return on cash, you would need $180,000 of premium.
Yeah. Funny how that works. If you were going to maximally fund this policy, now it's 6 times that original plan premium, which is $180,000. That's the capacity every year, not just one, but every year. So you don't have to have a whole lot of mathematical intuition to realize that, wow, that's going to compound by a difference that's a lot over time.
Yeah.
There's $150,000 that you should be putting into the policy that you're not putting into the policy for a long, long time.
Right.
Suffice it is to say, the fees of that policy are going to be a good bit higher than we would like.
Yeah. Obviously.
We have addressed this issue before, but just quantified here. The expenses of this indexed universal life insurance policy. If we talk about them in relationship to the cash value that's in the policy,
right?
They look really high in the beginning because they always do with indexed universal life insurance. It doesn't have a lot of cash value in the policy in the beginning,
right?
So
and the insurance company is recovering their acquisition costs for the business.
Yep. So fees charged against the policy in year 1 are nearly 30% of the cash value in the policy.
Right.
They drop very quickly. In fact, by the time we get to year 10, fees of the policy represent about 1.33% of all the cash in the policy. And they keep dropping substantially from there. In fact, we bottom out at 0.1% of the cash value in the policy. That's mid 60s, by the way. No, sorry, I'm wrong. 0.7. 0.07. Sorry, 0.07. Let's see the numbers right, Brandon. We've averaged these out before in the past to point out that long-term average expenses on indexed universal life insurance for the lifetime of it is probably in the area of 0.2 to 0.25 of cash in the policy, which is one hell of a deal when it comes to managed money. So not bad at all.
Right.
Now, at age 90, that goes up a little bit because cost of insurance does rise. 0.4% is what the fees against the policy are. Relative to the cash value, which happens to be 1.97 million, almost 9.8.
No, not 1.7.
Sorry, I said that wrong. 9.7. 9.7.
9 times.
Almost 9.8 actually. $1 million.
And the death benefits 10.25 million.
10.2. Yeah, 10.25. That's a good point. 10.25 on a policy that started out with $637,000.
Yeah.
That's good growth. And you only got to pay 0.4% of the cash value to get that.
Yeah.
And by the way, this particular product does have an index option that allows you to have a 1% guarantee, period. Yeah. So you can exceed the expenses of this policy by virtue of just using that index option. And the index can do whatever it wants to. It doesn't matter. You are exceeding the fees charged against the policy.
Right.
So it's fine. Now, if we go to that 6 times the initial non-mech death benefit scenario, the fees in year 1 are 3,754% of the cash value in the policy. So,
in other words, nobody would buy that policy. That's
shouldn't want to. By the time you get out to age 90, the fees being charged against that policy are 43%, 44% almost of the cash value in the policy. That's bad. That's really bad.
Yeah.
That should never happen. And In fact, the fees, they stay above 2% for most of the lifetime of this policy.
Yeah.
So Insurance Pro Blog pro tip, if you're looking at the fees of your index universal life insurance policy and they never get below 2% of your cash value, you have a big problem on your hands. You should do something about that.
Yeah. That's very inefficient.
Mm-hmm. I'm sure the lay people aren't quite going to get our point because we are deeply, 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 deeply involved in the insurance industry every single day of our lives. But this is a stark example of how bad you have to execute this in order to create a problem.
Right.
Because even if we look at like the 3 times scenario, so that's a $1.9 million death benefit at inception, way too high. 3 times the initial non-MEC death benefit means the actual capacity to fund this policy is $90,000 a year.
Right.
Even in that scenario, the fees against this policy average out to like 0.5 maybe lifetime.
Yeah.
And that is
not the best, but not the worst.
That is far too inefficient for our liking.
Yeah. And that's only 3 times.
Mm-hmm.
Yep. And on the design that failed, the 6X design, finally, where it actually failed. The problem, I just want to point out, the problem is not with the index universal life insurance. The problem is that the hypothetical person in this hypothetical illustration is paying a $30,000 premium when they should be paying a $180,000 premium.
Yep.
Or I don't know where the sweet spot is on that one. It's probably nowhere near 180,000 actually, in terms of what it would take to keep it in force. We know it already. I mean,
well, I could hazard the guess that if you were to double to maybe 2.5 times that $30,000, you very likely could keep that policy in force for lifetime.
Yeah, the cash would start to get really thin. By the time you got to your 80s and 90s, for sure.
Mm-hmm.
But it's just an illustrative point. It's just to say the problem is not the policy. The problem is there's not enough premium being paid.
Right. It was put together incorrectly from the outset.
Right.
Now, consumer advocate types might ask, well, why would the insurance company let somebody do this in the first place? Oh, there are a couple of reasons why that might be the case. There might be an assumption that they're starting at 30,000, but they're going to get to a higher number sometime later. That is something that people claim they're going to do.
I'm laughing because it's something we've heard.
Yeah.
Dozens.
And it's
dozens.
It's something that frankly, I am not super in love with accepting as an answer with people when they say that. Unless they tell me for certain, like, look, I got a big house payment or something like that, and it's going to get paid off in 2 years, and then I'm going to redirect that money over here. Fine. I can go along with that. But, I just kind of think that my income's going to go up and I'll be able to put more money in there later. I've heard that before. So that is one reason why they might do it or might implement it. And to answer your previous question, if you put double the money, so $60,000 into that 6 times death benefit scenario, it works. It doesn't fail.
Yeah.
I just went in and ran it.
Sure.
So there are a few reasons why the insurance company might not get in the way, but I can tell you because we actually put these things in force. That there are times we get questions about why the death benefit is where it is and the premium is where it is.
Yep.
With a policy that's been proposed, if they are not non-modified endowment contract solved for death benefits,
right? Which
is rarely ever the case for us, but in scenarios where that happens, there are sometimes questions about why this is going on the way it's going on. Something else I do want to point out in that kind of context, though, because and I want to just use the 3 times death benefit to kind of illustrate this point. So that's a $1.9 million death benefit versus the $637,000 death benefit. I'm rounding a little bit here. So we start out with a significantly higher death benefit over $1 million more of death benefit at inception.
Mm-hmm.
But because of the drag that extra death benefit, therefore extra expense, has on policy performance, by the time we get to age 90, we have a smaller death benefit on that 3 times the initial death benefit policy than when we just start out the way we're supposed to. I'm saying supposed to because that's my bias.
Because that's your opinion.
Yep, minimum non-net death benefit. So 10.2, almost $10.3 million of death benefit when we do it the right way. 7.78 million death benefit when we do it the slightly wrong but not totally terrible way.
Right.
So inflating the death benefit at inception, it gets you more death benefit at the start, but it really doesn't bring anything extra to the table unless, again, there's some very solid plan to put more money into the policy at some point in the future.
Right. Right.
Because you are also sacrificing performance of cash value and even death benefit over time versus just starting out the way you're supposed to.
Yep.
And for the individuals who come to us and say, yeah, but I need more death benefit, our answer defaults to, you need to buy some separate term insurance.
Yep. Well, in many cases, if you buy a 20 or 30-year term policy, the IUL has caught up and or surpassed that by the time. Mm-hmm. And most people have they may have an infinite need for some life insurance, but they have a finite need for a certain amount of life insurance.
Yeah.
If that makes any sense. Probably not to anyone listening, but it makes sense to you and me, so.
Dull men of profound statements.
I'm just saying, oftentimes what we see is that, we have people that need $5 or $6 million of death benefit when they're in their 30s and 40s. But by the time they're in their 60s and 70s, maybe they only need, or they would like to have, in most cases, $1 million or $2 million.
Yep.
So the term insurance is no longer necessary at that point.
Yes. And for the individual who's looking at something like this, like the death benefit that you get from buying this policy maximized for cash growth, if $30,000 a year is going to go into it, it's only $637,000. If that person says, well, I really need $3 million of death benefit outstanding, you do not want to buy, or you do not want to put in force $3 million of death benefit and only put $30,000 into it. If that hasn't become abundantly clear to you with the discussion that we've just had for 27 minutes, I don't know what to tell you.
Right. Don't do that. Yeah.
Like that's a separate policy with term life insurance to get you to where you need to be. That's how that works.
Yeah. And we've done, we've had that discussion with people before, and, maybe 30 in this hypothetical, the 30,000 is the maximum budget they have.
Mm-hmm.
Okay. That's fine. Need more death benefit? Then we're going to back down.
Yep.
The index universal life policy to maybe $25,000, and now we got $5,000 a year for a term insurance policy to backfill the death benefit need. We've done that. I don't know how many times, a dozen or more.
Yep. And that's totally fine. You need the death benefit that you need, but don't.
And your
don't
budget
do
is
it
what
at
it is. So we're not.
Yep.
We're going to try to make that work in the most efficient way that we possibly can.
Right. Don't do it at the peril of the functionality of the universal life policy, because that's not going to get you anywhere.
Right.
That's not a way to optimize things.
Yeah.
So the claim that these things are going to fall apart is built on a small grain of truth, but the magnitude to which it is suggested it will happen is grossly, grossly overstated. Now, there's always going to be,
which it's stated it's going to happen.
There's always going to be a crowd of people who will point out, but there are people who are putting these things in force incorrectly on the daily. Were you not paying attention to the lawsuit at Pac Life and the race car driver just recently? Yep, I'm aware. It happens. People are dumb. Not the race car driver, the agent who sold it. I get it. But that is not a piece of damning evidence for universal life insurance.
No. It's a damning, it's a one more brick in the wall against the character of human beings.
Right. Right.
I mean, it's not good that it happened, but it's not an example of a bad product. Writ large, meaning universal life insurance. The Pac Life product, we got opinions. But anyway, it has a lot more to do with bad behavior.
Yeah.
That's it. I have one last question for you before we wrap this up.
Yeah, that's fine.
So what's the easiest way to find out if you have a bad design?
You go to the insuranceproblog.com, you click the contact us button, and you can either schedule a call or you can send us a message and have your illustration ready. And we'll totally look at it and tell you.
That's a great answer. Not the one I was looking for, but I like I like the cut of your jib, sir. I like where your head's at. As it relates to a whole life policy, that's what I was looking for.
Oh, I gotcha. So you should take your death benefit on your universal life policy and pull up a quote for whole life insurance and see how far apart they are.
Right.
So if the death benefit, or excuse me, the premium for the same amount of death benefit on whole life insurance is like twice or 4 times the premium that you're planning to put into a universal life policy, that's a big problem.
Right.
Because as we have pointed out in the past, there is no magic bean that the insurance company has because it issues universal life insurance that suddenly makes it cheaper to put life insurance on you because it's universal life insurance.
Right.
So it costs the same regardless, which means there is not going to be some sort of steep discount for one product versus the other.
Yep. They use the same mortality tables for both products.
Mm-hmm. Mm-hmm.
The probability of you dying at a certain age is the same.
Yep.
That goes for term insurance too, by the way.
Yep. It does.
Yep.
All right. Any other thoughts on this?
No, just that everyone should go over to theinsuranceproblog.com and contact us if you want to talk about this.
Sure.
Or anything else.
We can do that. That's a good plan. Anything else, literally anything else. Brantley is here talking to you about whichever.
Want to talk about your kids? I can one-up you.
Mm-hmm.
Don't worry about it.
Predictions on the Strait of Hormuz.
I'm all out of those.
All right. I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.